Hey everybody, my name is Paul Ficheski and welcome to the Real Estate Classroom YouTube channel. Like always, before we get started, give this video a thumbs up, hit that red subscribe button, click on the notification bell, comments, questions down below. That would be awesome. In today's video, it is part 2 and the final video on the entire appraisal series that we've been doing. In today's video, we're going to discuss the income approach to value using the capitalization method. So let's get to today's video. All right, so the capitalization method, or sometimes or commonly referred to as the cap rate or the capitalization rate, it includes a formula that you have to know for your real estate licensing exam. And the formula is on your screen. It's I divided by R equals value. And that stands for the net annual operating income divided by the rate equals the property's value. We use the capitalization method to value for larger properties, commercial properties, those type of things. And the cool thing about this particular formula is if you have 2 out of the 3 values, you can calculate the third value. So if you have the net annual operating income and you have the value, you can determine the rate. And I'm going to show you some examples on how we do that. And then I want to talk about the rate, the capitalization rate, because there's a lot of misconceptions out there when it comes to that term. The capitalization rate is actually in direct correlation to the level of risk, which ultimately impacts the investor's rate of return. Some people will say it's the rate of return and other people will disagree, but it's all of those things, and I'm going to explain what I mean in this video. Understand, though, primarily the capitalization rate is talking about the risk, the level of risk of the investor. And the lower the capitalization percentage, the less risky the investment is. The higher the cap rate, the greater the risk is. And let me give you an example. Let's say that you have a property that's leased out to the Department of Motor Vehicles. It's a 25-year lease. It's going to have a lower capitalization rate because it's a lower risk versus if it's let's say a gym where there's a lot more risk. It's a shorter lease, those type of things. So there is a direct correlation between the risk and the rate. It also impacts the return on the investment for the investor. Certainly the higher the cap rate, the more income, So those are the things that we all take into consideration when you're using the cap rate. And remember, every investor, they have different objectives, and they can use the capitalization method to calculate those objectives. And I'm going to have some different scenarios here that I think will illustrate exactly what I'm talking about. But I wanted to have the little discussion before we move forward about the rate itself. All right, so let's look at the formula. We have the net annual operating income divided by the rate equals value. Number one, the net annual operating income. How do we calculate that? Now, if you're buying an existing building, we know that there's already going to have that historical data available to the potential buyer. But for the purposes of those of you that are studying for your exam, many times there are test questions where you kind of have to calculate the NOI. They'll give you all the information that you need, but then you're going to have to know how to calculate that net operating income. So we take the gross annual income and we minus or subtract the annual operating expenses, and that gives us our net annual operating income. Now, what are considered operating expenses? Well, that could be rents, that could be lease fees and stuff on copy machines and postal machines. It could be payroll, it can be taxes, it can be insurance, anything that's an expense to run your business. Okay, that is basically what an operating expense is. So let me give you an example. Maybe this particular property has $50,000 in gross income from the leases that it has, and there's $35,000 in operating expenses. That gives us a net operating income of $15,000. Don't forget, that's net annual operating income. In our previous video where we talked about the gross rent multiplier, that was gross monthly income. And you have to remember the differences between the two approaches. Otherwise, you're going to get any potential test question incorrect. So, capitalization method, we use the net annual income. All right, let's go to step 2 here. Step 2 is now we determine the rate. We already know, if you look on your formula, that we established that the net operating income is $15,000. Now, what's the rate and where do we get the rate? Well, it can come from a couple of different places. And I know there's going to be a few of you that disagree, but so what? Give this video a thumbs down. That'll still help my the channel grow. So, and I mean that sincerely. There are some people that they're so dogmatic about where this comes from. It's not the rate of return, it's the risk. And other people will say, no, it's all about the investor's objective. I'm just going to tell you that it's used in all these methods that I have on your screen. Number one, one way we can get the cap rate or the capitalization rate is we can go into the community and find comparables that have already sold. Comparable properties that have recently sold in the area. And then we do an analysis, and we'll take the property's net operating income. Remember, net annual operating income, and we divide it by the selling price, and that will give you a cap rate. That is one way. Another way is, I've seen this where investors, they have a minimum capitalization rate that they want because that's a direct reflection on the return on the money they're investing. So the investor themselves dictates what that capitalization rate is going to be. The third way to get that cap rate is there are services out there where that commercial type real estate professionals can become members of, and then regionally they will publish the capitalization rates within a region and also within a genre of business. So they'll have let's say for Nebraska, they'll have the scale of the capitalization rates, and for this type of property that's going to have a liquor store, here is the average cap rate, or if it's a government lease, here is the average cap rate. And that way the appraiser can tap into that, or the investor can tap into that as well. So those are the three ways that you get the cap rate or the capitalization rate for the calculation. Now, I know the question is going to be, well, how do I know which to use? And the answer is you won't, and you won't need to. The question is going to give you all the information on your exam that you're going to need to calculate the problem. In fact, typically they'll just say, hey, the capitalization rate is this, and the capitalization rate, the net operating income is this. So they're going to give you all the information that you're going to need to make the calculation, right? But remember, the rate is a direct reflection of the risk to the investor, and that certainly does impact the investor's return on their investment. So we have the net annual income of $15,000 in our little scenario here. Now the rate, let's say we done some calculation, or we looked in our book, or the investor minimum is 10%. So now we have 2 out of the 3 values where we can get the third value. So the NOI, the net operating income, is $15,000. The capitalization rate is 10%. And how do we calculate that? Well, it's real simple. We take 15,000, divide it by 10, hit the percent key, and that's going to give the valuation of the property. That's net operating income divided by the capitalization rate equals value. That's essentially what the formula is. Now remember, I talked about two. We can as long as we have 2 out of the 3 values, we can get the third. This is kind of a cool little thing to know too. So let's say, for example, we have the value is, let's say the value is given to us in the test question, and the net operating income. We can now calculate what the rate is. Maybe the test question will give you the cap rate and the value, or the list price, and they're asking us to calculate the NOI. And here's how we do that. So using our numbers that we've been using throughout this video, let's say that the net operating income is $15,000 and the list price is $150,000. What's the capitalization rate? Now, in where would we see this in a real life scenario? So let's say that I'm looking at a property that I want to buy. There's already a history and documented NOI, which is the net annual operating income, and the property's at $150,000 list price. But maybe I'm an investor that has a specific minimum on the cap rate that I do not want to go below. So I can take the information, I know the list price, I know what the historical NOI is, I divide those two numbers. So we take that $150,000 list price and we divide it by $15,000, and that should give us a 10% cap rate. That's, again, as long as you have 2 out of the 3. Another scenario gives us the capitalization rate is 10% and the property is listed for $150,000. So what should the net annual operating income be? So we're going to take that $150,000 and multiply it by 10, hit the percent key, and when we do that, that should give us the NOI of $15,000. Again, it's just a way to calculate, but notice one thing here. In 2 scenarios, we have to use division. In 1 scenario, we have to use multiplication. And so you're going to have to remember that and commit this to memory. You just have to. That's just the only thing I can tell you, because you don't know which style or how they're going to phrase this test question regarding using the capitalization approach. They may ask you for the net operating income, they may ask you for the rate, or they may ask you for the value. The bottom line here is if you know the formula, and you know when and where you need to divide or multiply, and you commit that to memory, then quite frankly, there isn't any capitalization type question that you're not going to be able to calculate for your real estate licensing exam. All right, if you're going to continue studying, check out this video to my right. It's a good one. If you have not subscribed to our channel, please do so. Click the little circle to my left. Other than that, that's it. I'll see you in the next video.